Hi, hello friends. Myself Sanjay. Today I am discussing about accounting cycle. First, we discussing accounting meaning. Accounting cycle meaning. Accounting to the going concept. It is expected that business will continue or forgive the accounting process started through the identifications of transactions and ended with preparing financial statements. Accounting 10 steps of accounting cycles. First one is identification of transaction, journalizing, posting of ledger, preparations of trial balance, adjusting entry, adjust trial balance, prepare of financial statement, closing entry, post closing trial balance, reserving entry, reverse entry. Identification of transactions. First, the first step of the accounting cycles in the identification of transaction. Transaction or identification after analyzing all events. The only financial transaction would be consist a transactions. The transactions may including the purchases of goods, selling of goods, and operating expenses, any payment, etc. Second one is journalizing. The second step of the accounting cycles is journalizing. Her analyzed transactions are recorded in the primary books of accounts as debit and credit in chronological orders. Purchase books, sales books, purchase return books, sales return books, not reservable books, not payable book or the primary books of transaction recording. Third step is posting to ledger. The first step of the accounting cycle is ledger. Ledger is the main book of the accounts. Her transactions and transfer into the ledger as a special head of the accounts. Different ledger is prepared of the account head of accounts such as purchase account, sales account, salary account, advertisement account, capital account, building account, and etc. Fourth one is preparations of trial balance. The fourth step of accounting cycle is preparation of trial balance. It is prepared to respectfully to the mathematics account across of the record transactions. The trial balance is prepared with the conceptual account at along with the debit and credit balance of the ledger. It is prepared at a period in a time period. Fifth step is adjusting entry. The fifth step of the accounting cycle is adjusting entry. The journal entry is given for adjusting accrued and prepare income and expenses to identify the actual financial conditions of the business of the particular accounting period is called adjusting entry, such as adjusting entry for for salaries, preparing insurance premium, and relating realized income and expenses, etc. Sixth one is adjusting trial balance. The sixth step of accounting cycle is preparations of the adjusting trial balance, or against the adjusting transactions is transferred to ledger as a separated head of the accounting. Then the adjusting trial balance is prepared with the account balance of debit and credit of ledger. Seventh one is preparations of financial statements. The seventh step of the accounting cycle is the preparations of financial statement. The financial statement is prepared to identify the profit or loss, assessed liabilities and one's equity of the business and at end date of the accounting period. Eighth one is closing entry. The eighth step of the accounting is a closing entry. There are two steps of the accounting in each business. One is income and expense related account. Another one is assets and liability related account. The necessary of income and expenses related accounting are finished in the accounting period. So closing entry are given closing to balance of revenue, expenses and drawings account at the end of the year. Then next step is post closing trial balance. The ninth step of the accounting cycles is the preparation of post-closing trial balance. After closing entry ledger, balance of income and expenses become zero. The next accounting period will start with the remaining balance of assets, liabilities, and owns equity account. Post-closing trial balance is prepared with the assets, liability, and owns equity liability of ledger. Then last step is reversing entry. The 10th and final step of the accounting cycles are reversing entry. Reversing entry is obtained opposite of the adjusting entry made in the last accounting period. Adjusting entry are made at the beginning of the next accounting period. Thank you for giving this opportunity. Thank you.